Hello, we are Group 12, Sungun, Hangyer, Taeun, Hyungon, and Isak, and we'll be discussing, can ESG firms also be efficient and profitable? The first portion of this presentation will be introduction and conceptual framework, the second literature review, the third result analysis, and the fourth conclusions. Why ESG now? In today's business landscape, ESG, environmental, social, and governance, has become a strategic necessity. Global issues like climate change and inequality have pushed firms to take responsibility beyond profits. Major investors like BlackRock and NBIM now rely on ESG ratings to guide investment decisions, often divesting from firms with weak governance or environmental performance. At the same time, OECD, regulators, and civil society are pressuring companies to disclose ESG practices and integrate them into long-term strategy. This shift raises a critical question. Can ESG-oriented firms also be efficient and profitable, or does responsibility come at a cost? Current firms face a unique ESG landscape. Governance weakness, such as insider control and low board independence, make governance a top priority for Korean companies. At the same time, Korea's global competitiveness relies heavily on innovation in semiconductors, ICT, green energy, and biotech. Firm size also matters. Large firms like Samsung face heavy ESG scrutiny, while smaller firms struggle with limited resources and high reporting costs. Korea must keep pace with this global ESG push. In export-driven sectors like semiconductors and green tech, ESG is becoming a requirement. While challenges remain, adapting is no longer optional. It's essential for staying competitive. So what exactly is ESG? ESG is a framework that evaluates a company beyond traditional financial metrics. The environmental pillar assesses how firms manage climate impact, emissions, and resource use. The social pillar focuses on labor practices, human rights, and community engagement. Governance evaluates leadership, transparency, board structure, and ethical decision-making. Together, these elements determine how responsibility a firm operates. ESG drives two key outcomes: corporate sustainability and efficiency. Corporate sustainability means aligning business strategy with long-term environmental and social value. Corporate efficiency reflects how well ESG practices are used to reduce risks, cut costs, and enhance operations. When ESG is integrated into the core of a business, it becomes a lever for smarter, leaner, and more resilient management. In our study, we assessed four key corporate financial performance metrics. ROA, return on assets, measures how efficiently a firm uses its assets. ROE, return on equity, captures how well it rewards shareholders. Tobin's Q reflects market value relative to asset replacement costs, signaling future growth. And market value shows investor perception through share price and outstanding shares. These indicators help us evaluate whether ESG contributes to both financial and operational success.
In this section of the presentation, we aim to study various research articles, analyze positive and negative impacts of ESG governance activities on CFP of firms. Ultimately, we're going to explore main research questions and following hypotheses for investigation. For the positive impacts of ESG on consumer financial performance according to the research articles, first positive impact is that there is an enhanced firm value through governance improvements. Also, according to the research articles, ESG could stimulate investor engagement as a performance driver. For the third positive impact, ESG could be used as a tool for risk management and financial flexibility. And lastly, for the fourth positive impact, could be innovation synergies through ESG-aligned governance. However, there are also negative impacts of ESG on corporate financial performance according to the research articles. First negative impact is that there are high compliance costs and operational burden. And also, for the second negative impact, there are innovation trade-offs post-IPO due to ESG pressures. Third, there could be reputational risks from ESG washing. And fourth, finally, governance rigidity suppresses risk-taking behavior. Following the literature review, we were able to explore several research questions that we aim to investigate through this project. We came to several research questions such as, do firms with higher ESG scores demonstrate superior corporate financial performance as measured by ROA, ROE, Tobin's Q, and market value? And for the second question, does leverage moderate the ESG CFP relationship such that investors view ESG spending as risky if a firm is already financially stressed? And lastly, for the third research question, does firm size moderate the ESG CFP relationship such that larger firms with more resources and public scrutiny gain more financial benefit from ESG initiatives than smaller firms? And for the following hypotheses, we came to several hypotheses that, such as firms with higher ESG scores exhibit better corporate financial performance as measured by higher ROA, ROE, Tobin's Q, and market value. And second hypothesis, leverage negatively moderates the ESG CFP relationship, such that firms with high debt levels show weaker positive associations between ESG scores and financial performance. And lastly, for the third hypothesis, we came to hypothesis that firm size positively moderates the ESG CFP relationship, such that larger firms show stronger positive associations between ESG scores and financial performance.
To begin our analysis, we first identified the key variables that define corporate performance and sustainability. Let me walk you through each of them, starting with our dependent variable, corporate financial performance. This represents the financial outcomes we are trying to explain, and we used 4 indicators to capture both accounting-based and market-based performance: ROA, return on assets, and ROE, return on equity, Tobin's Q, and then market value. Our primary research interest is whether ESG efforts contribute to firm performance. So we incorporated 2 main independent variables into our model. First is the ESG governance score, as we previously explained in depth. Second, we incorporated R&D intensity. In answering the research question, can firms concerned with ESG also be efficient and profitable? We should compare the relative contribution of ESG with more traditional performance drivers, like R&D intensity, which is strongly associated with productivity, competitiveness, and long-term firm value. So, R&D intensity is there as a comparison, and to compare a well-established independent variable with a newer factor of ESG. It measures how much a firm invests in research and development relative to its size. It essentially captures the innovation capacity. We calculated R&D intensity as R&D expenditure divided by total assets. Next, we hypothesized that ESG's effects on performance may not be uniform across all firms. So, we included 2 moderators which interact with these relationships. First, the size of the firms. Larger firms may have more capacity to implement ESG practices, and investors may respond differently to ESG in large and small firms. We measured firm size as a natural log of total assets. Second, leverage. High debt levels can affect how ESG efforts are perceived. For instance, investors may view ESG spending as risky if a firm is already financially stressed. Leverage was calculated as total liabilities divided by total assets. To test for these moderating effects, we also created interaction terms, which is ESG multiplied by size and ESG multiplied by leverage. These help us understand whether the relationship between ESG and performance depends on firm size or capital structure. Now, before moving on to the regression analysis, let me briefly explain the control variables we included in our model. In this study, we chose to include only Korean manufacturing firms, since manufacturing firms tend to have more standardized financial structures and ESG reporting practices compared to service or IT firms, which helps reduce structural heterogeneity in our data. Also, this restriction allows us to focus the analysis on intra-industry differences, such as how governance and innovation affect performance within a relatively homogeneous sector. Our second control variable is time. Since we are working with panel data from 2017 to 2023, macroeconomic conditions such as interest rates, global trade shifts, or pandemic could affect all firms regardless of their ESG or innovation levels. To control for this, we included a year variable in all models. This helps ensure that the effects we observe are not just due to time-specific shocks that impact all firms simultaneously. Next, collecting and organizing data. I used FN Data Guide software and the data that the professor had given us, and eliminated all data that did not have value in the time period of 2012 through 2023. Initially, we considered firms for 2012 to 2023, but many observations in the early years had missing values. Consequently, after removing all companies with incomplete time series, we set our final analysis period from 2017 through 2023. In total, after filtering and cleaning, we obtained 476 firm year observations across 68 manufacturing firms. This sample was large and robust enough to perform regression analysis, with interaction terms and multiple control variables. With our data collected and structured, we moved on to the statistical test. We used multiple linear regression analysis. We applied pooled ordinary least squares regression model with year-fixed effects. This is our regression model, and we ran 4 separate regression models, each using a different dependent variable to represent the CFP. We conducted the statistical analysis in our software using this R code, and here are the results. But before we go through the results of the ROA model, I'd like to briefly mention the multicollinearity. Because our model includes several related variables, including interaction terms like ESG size and ESG leverage, we needed to make sure that our independent variables are not too highly correlated with one another. To assess this, we mean-centered to reduce multicollinearity and then checked using the VIF function in R. All VIF values were below 5 as can be seen in this picture, which confirms that multicollinearity is not a concern in our model. Let's look into the first model of our regression models, the ROA model. The model itself is statistically significant, as can be seen in the F-test p-value of 0.0036. The ESG score alone does not show a significant effect on ROA. Yet, we can see that R&D intensity also does not significantly predict ROA in this model. Since no alternative explanatory variable is significantly improving ROA either, it is not plausible to conclude that ESG does not improve ROA. So we have to look into the other models. Next, the ROE model. This ROE model was not statistically significant. The model itself had the F-test p-value of 0.2706, so there is no point in interpreting this. Moving on to our third model, we analyzed Tobin skew, which reflects how investors perceive a company's future growth potential. This model is statistically significant overall, as can be seen in the F-test p-value. And the ESG governance score had a negative but non-significant coefficients of p-value of 0.11, suggesting that we cannot conclude that ESG alone strongly influences the Tobin skew. In contrast, R&D intensity has a strong positive relationship with really low p-value. Thus, we can conclude that ESG alone does not have a strong or consistent impact on Tobin skew. The other moderator coefficients were all non-significant. Now, I will explain the final and most robust model in our analysis, the market value model. This model was our strongest statistically. As you can see, the p-value is the lowest of all, and the ESG governance score, when we look at the ESG coefficient, the ESG governance p-value was not significant, which was a 0.35, and it is consistent with our earlier models, reinforcing the idea that ESG by itself does not universally increase firm value. There is a reason why we emphasize that ESG by itself does not increase firm value, and we will explain it just later. Once again, compared to ESG score, R&D intensity had a strong positive relationship. However, this model revealed significant interaction effects. The ESG firm size interaction term was positive and highly significant, and it was lower than the p-value was lower than 0.001. It indicates that the ESG efforts boost market value more for larger firms, likely due to better ESG reporting, resource capacity, and investor trust. Also, the ESG leverage interaction term was negative and significant, which had p-value of 0.003. This means that ESG efforts in highly leveraged firms may reduce market value, possibly because investors view it as inefficient or risky use of limited resources.
Building on that, I'd like to briefly walk us through the key implication from our finding and what we could mean in practice. Let's start with big picture. First, ESG alone doesn't guarantee better finance performance. Across all models we run, whether it was ROA, ROE, Tobin skew, or market value, ESG score by themselves didn't consistently lead to better outcomes. Especially when we look at short-term profitable merit like ROA, ROE, ESG doesn't seem to be a magic bullet. That suggests ESG need to be part of a broader, more integrated strategy, not just a checklist for compliance. Second, R&D is still king. R&D instantly came out as one of the strongest predictor of frame value, especially for market-based metric like Tobin skew and market cap. This reinforced the idea that investors reward framed for their innovation and long-term growth potential. But here's where I get more nuanced. Our ESG
impact really depend on the firm's characteristic. For example, ESG had a positive effect when the firm was larger, like because larger company have more resources to implement ESG properly, and there's under great public security. But on the flip side, ESG spend had a negative effect when the firm had high leverage. This could be because investors see ESG in highly in-depth firm as a distraction, or even as a form of greenwashing. So putting it all together, ESG is not one size fits all tool. Its value depends on who's using it and how it's being integrated with a company's financial and strategic situation. Let me give you a few examples to make it more concrete. Samsung Electronics show us what it looks like when ESG and innovation works together. It has top governance score, high R&D intensity, and its market cap reflect the synergy exactly what our model predict. On the other side, SK Hynix deposit good ESG disclosures, struggle with investor skepticism due to high debt. Again, is that this fits our finding that leverage weaken the ESG effect. LG Chim stand out for innovation in green and material, which like support is high Tobin's Q. So in closing, the part of our study helps answer the core research question. Not only does ESG need to be paired with the right frame condition, but R&D and capital structure play a critical role in whether ESG become an actual value driver or just a surface level signal.
Questions. This study found that ESG governance scores alone do not significantly improve corporate financial performance across all models. However, when firm-specific conditions such as size, innovation capacity, and leverage are taken into account, the effects of ESG become more nuanced and meaningful. Large firms benefit more from ESG initiatives, particularly in terms of market value, possibly due to better ESG implementation capacity, higher public scrutiny, and resource availability. Highly leveraged firms, on the other hand, may face investor skepticism when engaging in ESG activities, as their financial stability is already in question. Corporate innovation consistently shows a strong positive effect on market-based performance, Tobin's Q, and market value, suggesting a complementary relationship between ESG and long-term innovation strategies. Implication for firms. ESG governance should not be adopted uniformly across all firms. Instead, it should be strategically aligned with the firm's size, capital structure, and innovation goals. For large firms, ESG can enhance market valuation and investor trust if integrated meaningfully. For firms with high leverage, ESG adoption should be paired with financial restructuring or clear signaling mechanisms to avoid market penalties. Implications for investors. ESG ratings should be interpreted in context, especially considering firm size and debt ratio. Investors may consider favoring firms that demonstrate both strong ESG and innovation capacity, as this combination correlates with higher market valuation. Portfolio strategies could be optimized by screening for firms with moderate leverage and strong ESG innovation synergy. Implication for policymakers. Policymakers should consider differentiated ESG reporting standards for SMEs and conglomerates. Incentive programs that encourage ESG-aligned innovation could help firms translate sustainability into competitive advantage. ESG regulations should be paired with education and support programs, especially for firms lacking capacity to implement ESG effectively. Limitations and future research. Limitations. First is scope restriction. The study focused solely on QRM firms listed on KOSPI and KOSDAQ, limiting generalizability to other contexts. Data constraints. ESG scores were treated as standards and externally rated, which may mask internal differences in ESG implementation depth or quality. Temporal limit. The period analyzed may be too short to fully capture the long-term impacts of ESG strategies. Cross-sectional bias. Missing values led to the exclusion of over 1,000 observations, which may bias sample representativeness. Future research directions. Sector-specific analysis could reveal how ESG impacts vary across industries such as tech, energy, or finance. Explore qualitative aspects of ESG governance such as board culture or leadership commitment beyond numeric ratings. Investigate longitudinal effects of ESG adoption using panel models or difference in difference methods. Study ESG misalignment more deeply and its impact on investor sentiment over time. So, to conclude, this study examined how ESG governance scores interact with firm-specific factors to influence financial performance. While ESG alone does not guarantee better financial outcomes, its effects are context-dependent. Notably, ESG initiatives are most effective for firms that are large, innovative, and financially stable. These firms not only benefit from scale economics in ESG implementation, but also signal long-term value creation to investors. The findings underscore the need to move beyond blanket ESG adoption towards strategic integration tailored to a firm's characteristics. ESG, when aligned with innovation and supported by sound financial management, can become a value-creating strategy rather than a compliance burden. Thank you so much.